Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the podcast, host Craig Jeffery sits down with J.R. Robertson, Vice President of Coupa Pay at Coupa, to discuss why the beginning matters for working capital optimization. They take a comprehensive look into the history of working capital management, the pain points and drivers for suppliers, the next evolution of financing, and more. Listen in to this lively conversation.
Welcome to the Treasury Update podcast. This is Craig Jeffery, and I am joined by J.R. Robertson, who's the VP of Coupa Pay at Coupa. J.R., very excited to be talking to you about working capital optimization.
Thank you, Craig, for having me on the podcast. It's an honor to speak to such a great community of Treasury and finance folks. I think what I'm most excited to bring to the table today is the 20 plus years of experience in procure-to-pay networks and ERPs, and how the impact to a lot of these networks can drive a lot of value for your Treasury audience. Coupa has been rapidly expanding our depth and breadth and influence into the Treasury and finance functions. And I've had the great opportunity to get to know some really great customers at some of the largest innovative companies in the world. So hopefully I can add a little bit of wisdom that I've learned over these years, and we'll have a great dialogue.
Yeah, that sounds good. So Coupa has Coupa Pay, Treasury, working capital. Treasury was formerly called Bellin. Now that's Coupa Treasury. So looking at the entire liquidity, enterprise liquidity across the zone. But I wanted to jump into, I don't know if we want to call it a working capital history or just some background on working capital. Maybe we should start with, there's a couple definitions of working capital. One is the accounting banking, which is current assets minus current liabilities. And I just want to be clear, we're not talking about that part today. How would you define this liquidity management view of working capital, JR?
Yeah, I think, definitely it's how we can use our kind of day-to-day operations and cash balances, whether that's, corporate balance sheet or even credit available through, strategic bank partners, to drive yield and drive value, not just for, your corporate businesses, but also drive liquidity and value to your supply chains. So I think I'd like to focus on that primarily.
The traditional current assets minus current liabilities is that accounting or banking definition, which is really just geared towards, do you have adequate liquidity to meet obligations as they come due? And then the focus on another definition tends to focus on accounts receivable, inventory, and accounts payable as an efficiency measure, and your focus is on the overall balance sheet, including AR, AP, and inventory, being able to optimize those. So a little bit of a combination of both. When we think about working capital, making improvements in working capital, sometimes that is solely focused at the end of the process. The idea of, we're going to pay slower, so we're going to improve our DPO by paying later. At least that's perhaps an immature view of it. So the view might be just at the end of the process, as opposed to a more comprehensive look. This idea of working capital program improving or being more effective by moving up the chain is a point that I've heard you make at different times. Can you just give us some background or explanation of that?
I think historically, whether it's a bank providing financing or another fintech, helping corporates facilitate financing, the activity typically happens after an approved invoice, is run through an AP process, and then there's some instruction or some file that's shared. And it typically is at the very end of that process. And, I believe that there's so much that happens, in the front end of that process, whether it's identifying suppliers that will accept an early payment or need liquidity. It's getting the supplier information, right? I mean, that's a huge challenge for many corporates and banks, is just having accurate supplier information. You have the timing of the payment term and the settlement time. So that's another kind of variable that, oftentimes you have to plan and oftentimes have challenges around. So, I think the more you can solve some of this upstream working capital challenge, the easier it's going to flow. The more suppliers you can get into your program, the more value you're going to provide to your supply chain.
You mentioned the timing and terms, and also about this, I don't know if you want to call it, getting the supplier info together. How does getting the supplier info together solely about, I don't think that's what you're going to say, it's solely about efficiency, but are you indicating that there's some feedback loop onto the financial side of working capital optimization by doing that at the front end?
The more you know about the supplier, whether that's, how much spend you're doing with that supplier, understanding some of the liquidity needs of that supplier, the size, credit rating, whatever, understanding the supplier better and better is going to allow you to use all of these different working capital vehicles, where supply chain finance is one. You talked about PO and inventory finance. There's even credit, business credit cards or virtual cards. So there's a huge array of different kind of financing vehicles. And I think the better you know your supplier, the better you can prescribe the right financing vehicle for them, so that you don't inundate them with all the options. They're not confused by the offerings at hand, and you can be a little more prescriptive. And I think, that kind of falls in the bucket of kind of just user experience or supplier experience. And I think that's a key element to knowing your audience and knowing your supply base and their needs.
Maybe you could talk a little bit further about the history of working capital management. What's gone on and where are we today?
Trade finance has been around, thousands and thousands of years. So, we're not recreating the wheel here. I think just until kind of the 80s, the banks really started getting into, how can I help corporates, provide liquidity to not only themselves, but also their supply chains. And then over time, the fintechs have gotten involved and made it more efficient and made, supplier onboarding better, created technology that facilitated optionality both for buyers and suppliers. And that kind of brings us to today. And, I think at the beginning you asked a question, about working capital being at the end of the process. And I think historically, that's where this has been facilitated. And not until really, 4 or 5 years ago when Coupa got involved, did we see the true value of all the upstream data, not only to the banks, but our customers and suppliers, that we realized, we had a unique position in this kind of embedded finance network, right? There's been networks, there's been financing, but they've struggled to kind of marry the embedded financing within the business process. And I think that's where I think the next evolution of financing is going to go. And, it's clear in kind of the interest from, many of our bank partners, listening to some of the challenges they have in driving these type of working capital programs that, we provide something that a lot of the financing world has not seen before.
JR, thanks for that. I wanted to talk about this view of, sometimes you see in in the media, or people putting out information. It could be consultants who say there's huge sums of working capital that is trapped. And there's certainly a real sense where that's the case. And then there's another element where if we think about it simply as between two trading partners, that it's a zero-sum game. If I pay you later to improve my payables and how long it's taking me to pay, you're receiving money later. And so on a net basis between two trading partners, there's no difference there. So how is working capital a zero-sum game, and how does it change, or what's necessary for that, win-lose to change to a win-win?
Thanks, Craig. Yeah, I absolutely agree that, for this to be a net zero benefit or a win-win for these trading partners, the bank squarely has to sit in the middle. If I'm giving up DPO and gaining DSO, you're right. Like you're just trading DSO for DPO. And the banks are a really important kind of mediator here because they don't have the same liquidity crunch. They don't have the same timelines that a corporate has around their cash balances. And so they really are a strategic partner in making sure that this trade balance works itself out. And there's clearly a benefit for them, but I think they play a very important role in kind of this working capital optimization.
So if I'm a company making a payment and I'm cash rich, I might want to promote or take advantage of every time someone offers me a discount that provides me a better yield. And so I don't necessarily need a bank to take advantage of that. For example, if I'm collecting money, I'm just trying to see if I'm hearing you right. If I'm collecting money, I might want to get paid sooner. Other people, my customers may be trying to push out terms to 60 or 75, 90 or whatever number it is. So you're saying the bank can sit in the middle where some companies have excess cash, some are in need of cash or capital through this, and they can bridge that timing gap. Someone can pay at 75 days. I could collect at 15 days, right? That's better for me as a supplier. It's better for them as a payer, and the bank, who has access to better capital, can take advantage. Is that the type of example you're talking about?
Yeah, I mean, I think to that point, the cash-rich companies have the luxury of being able to keep their own supply chains healthy. Not every company has that ability, and so the bank's ability to kind of fill that gap and provide many companies globally the liquidity that their supply chains need to stay healthy. And then you have a combo of both, right? I might have enough cash to fund 30% of my supply chain, but how do I quickly pivot and use my balance sheet and the bank's balance sheet in a comprehensive program? And I think that's one of the challenges that many companies have, is they say it's either all my balance sheet or not, or all the bank or not. And being able to be flexible and nimble and point the liquidity spigot based on kind of time of the month or seasonality, you get the kind of the best of both worlds. But it does take technology to really help facilitate that dynamic kind of change in funding. So I think that's definitely what we're trying to help our customers achieve, is the nimbleness of their own balance sheet, but the flexibility and the ability to leverage these bank partners.
I like your comment about flexibility. Some of the survey data we have shows, I can't remember the percentages, below 30 or above 30, but it's somewhere near 30, where those are companies that move from a cash-rich position or cash-positive net investor to net debtor through different times of the year. So that's a pretty significant portion versus those that are always net borrowers or net cash rich. So I think that flexibility speaks to the audience, but it also speaks to the effectiveness of programs people put in place at their companies, because not everyone's taking advantage of, paying early or discounts at different times.
And I would say the suppliers have the same challenge, right? They have different liquidity needs at different times. And, I think many of these programs that exist today, they're kind of you're an all in or you're an all out. I mean, they would say that we'll finance you at any point. But the challenge is the way that we onboard suppliers. It's, I think many want the juice to be worth the squeeze, right? And so, they're not going to go after a supplier that might or might not want financing every once in a while. And so they kind of fall through the cracks a lot of times. And on top of that, you have a supply chain that churns 30% every single year. And so, the ongoing maintenance of these kinds of programs without technology, I think we're leaving a lot of money on the table, that gets stuck in the supply chain.
Yeah, I'll probably want to come back to that question about, how broad, let's say, processes could cover the landscape without tech. I mean, without, much more integrated tech. But I do want to just ask you some questions on the supplier side, for example. What are you seeing as the drivers to working capital optimization for suppliers? And maybe that's in response to pain points, or it's in response to opportunities or challenges. How would you describe the supplier situation?
I think you kind of hit on it. They're either needing to bridge the gap in short-term kind of liquidity needs, and they might not be able to get more credit from a bank. Equity lines or whatever vehicles they can draw on are just not available. And so how do you go and use what is available? And that is your AR. And so I think a lot of it is bridging the gap in key times, and other is being opportunistic of growth. With key buyers, right? You got to have enough spend throughput with that buyer to make it worth it. But I think we're seeing both sides of the equation. Suppliers needing to fill a gap, and also wanting to throw some gas on the fire to help grow in key critical times.
Yeah, it depends on the industry, but it certainly seems like a lot of buyers might be larger, have easier access to cash, cheaper access to cash than some of the suppliers. This can help ease up the supplier challenges, in a different way than we've traditionally seen. Anything else on the drivers for suppliers? Because I want to move on to end-to-end as soon as we've cleared that.
Well, I think it's worth calling out, that oftentimes in these programs, the suppliers who need the liquidity most aren't always the ones who get the help, because banks are targeting, the large dollar kind of low number of suppliers. What's the path of least resistance to the largest amount of flow? And I think, those aren't always the suppliers that need that liquidity the most. And so when you're looking at kind of your corporate working capital strategy, you want to have optionality and flexibility to get those in your supply chain that need it the most. And I think that's really, really key.
When we think about this idea of the cash conversion cycle and looking at things on a comprehensive level, this end-to-end, and instead of just focusing at the end of the process like we talked about when we started this discussion, to starting at the beginning, you had described some of those elements right when we started, but maybe you could talk a little bit more about how different organizations are leveraging the end-to-end view. Like, where are they finding opportunities? What's the reason for the success of these types of programs?
I think one of the examples is we have a customer, and this is the first time that I had seen organizationally treasury owning, sourcing, and contracting. And I thought it was really interesting from a corporate structure standpoint that Treasury would own the front of the process. But it makes absolute sense, because what they told me is that everything rolls downhill, and they were tired of, picking all of this stuff up at the very end and not having any leverage. And so what they did is they made sourcing and contracting under Treasury. And so they could control the payment terms. They could control, many of the supplier onboarding and things that they need at the front end of this process. And I haven't heard of a lot of companies, corporately structured like this. But when I heard that, I said, that makes a lot of sense. And that is actually pretty innovative in nature. And I think, that story kind of demonstrates why, having, visibility for Treasury throughout the process, starting at the very beginning when we're, negotiating payment terms and, what currencies we're going to transact in and, everything else that kind of goes into, onboarding a supplier and developing a supplier relationship. That's when you have all the leverage anyway. So why would you not want to kind of put those things on the table before you're actually a supplier to make sure that, everything's buttoned down and all your ducks are aligned all the way from beginning to end? Because I think that's what's going to allow you to have a much more seamless flow of process, visibility, and control of these types of programs and of just general Treasury function.
Yeah, that's really interesting, JR. I haven't seen that too often. I have seen this multi-year trend, or more regularly, where Treasury might have additional oversight over payment terms, like you said, supplier onboarding, or the process that's used there, as well as the process for settlement. Moving towards more electronic methods. So I guess, there's different ways to solve that problem, but it's, that's an interesting example. Why would you give those things up? What does procurement care about oftentimes? Price. They don't care about terms. If I can get a better price and, we'll pay instantly. Well, that may not be the best. That's not going to be the best solution for the organization. So that's a great example. So that's an organizational element. What are some of the other tools that you see perhaps becoming more popular over time to help, solve some of these challenges?
Well, definitely, I would say better visibility of what's going into the contracts, what kind of clauses around early payment are you putting in? I think in general, there's just not a real good repository of that kind of data for Treasury to manage at a high level. I would say that, really having the embedded finance, process integrated into a source to settlement, flow for the corporate. I mean, that is really key as a process kind of continuity. I think that, clearly supply chain finance, we talked a lot about that. Virtual card is a great vehicle for, a great lever to pull for Treasury organizations.
Let's take a jump on virtual card then. Maybe you just give a quick explanation and why is that a good lever?
Well, it's a good lever because, one, it gets suppliers paid earlier, so they get instant settlement. Two, especially when it's a virtual card kind of embedded in your process, now you can reconcile much easier. So you have a card with a PO to an invoice, and so the reconciliation all sits kind of in one place. And so, I know a lot of AP teams hate reconciling their credit card statements at the end of the month because they don't know where all these charges go to. So the ability to kind of streamline the process and streamline the reconciliation is big for everyone. You get the credit element, right? I get to pay now my supplier, but I don't pay the bank. I pay the bank on a term, whether that's 30, 40, 60 days. So that's a working capital element. And then, for much of the risk, I mean, the networks and the acquiring banks, they actually take a lot of the KYC on. So, if I pay with a card, now I don't have to onboard that supplier into my vendor master, my ERP. I don't have to give them any tax information because the acquiring bank's managing that. So there's the working capital and, operational efficiency kind of all rolled into one when you talk about a virtual card. It's a great solution.
Yeah. So the end-to-end view, the faster settlement for, one party, as well as looking at the efficiency. That's a good explanation of how people are looking at things broadly, and the solutions drive benefits in a couple different areas. We talked about, you mentioned churn rate, about churn of suppliers, for example, and I want to bring this in to the discussion with a question. Was working capital optimization an event or a process? And I know it's sort of saying, yeah, it's a process because there's a churn rate, but I want you to explain that a little bit more, the churn rate. So is working capital optimization an event or a process? Why? And how does the churn rate have an impact on the success of working capital, the success of efficiency?
So I think the answer is both. I think to your comment, many of our customers, they churn their supply chains 30% every single year. And so every year you have a new crop of suppliers that have or can have liquidity needs. And so, from a process perspective, I think that becomes a bit of a challenge, right? Because who's responsible for that? Is it procurement? Is it AP? It's definitely not Treasury. They're not, equipped and staffed for that kind of workload. And so, your ability as a company to build in a process, especially as part of supplier onboarding, to really understand the preferences and the needs and the profiles of your suppliers is really key. But it's also an event because sometimes you have suppliers that only need it once, or the nature of working capital is yield, and so that's an event to me. Is getting some of this yield as part of the process, and the reality is it's such low risk. I mean, you look at these treasury vehicles or bonds. I mean, they're so low, from a yield perspective, that why would you not redeploy your capital to, one, beat the yield of many things out in the market, but it's already a liability, so you already owe it. And so I think the arguments of not using the capital available to you as a corporation to help your supply chain, I don't think it's a matter of do you have the money or does the money want to be deployed? I think it really comes down to, I don't have a good process and I don't have a good technology to be able to manage it effectively. And so, you end up putting such a burden operationally on your team that the juice just isn't worth the squeeze, and it's not worth it. So that's what I'm seeing a lot of times across our customer base.
Yeah, thanks. The example of you have customers that have a 30% churn a year. That's I think that makes the point. Even if it's 20% or 15%, that's a lot per month. And without staying up on it, it's not a single event. It's an ongoing process. Anything else that has a big impact? Whether it's churn or whether it's something else. What else are you seeing that people should be mindful of to optimize their working capital over time?
Yeah, I mean, I definitely think the onboarding costs of bringing these suppliers on. I think it's really important to try to develop processes and to even for the banks, that's one of the most costly positions for them. And so I think everyone's trying to solve the supplier onboarding and kind of risk process. And I think that, for supply chain is a great carrot to be able to drive, better onboarding for, corporates. And so I think that's one capacity, that's one thing. I think the other is really kind of suppliers don't always want their customers to know that they might need liquidity, right? I mean, if I'm a key strategic supplier to a buyer, I don't always want my supplier or my buyer to know that I need cash. And so how do you make it indiscreet or even not make it an event, right? I always say where there's smoke, there's fire. Like as a buyer, I would want to know if my supplier needs liquidity, because not that I would make buying decisions solely on that, but I would understand that, they might not be a supplier of strength. And so I think there's even some kind of byproducts of these programs that can help you make really educated decisions and know your supply chain better. And so I think, again, it's all about knowing the supplier. I talk a lot about supply chain health. It's really supply chain health insurance, right? I mean, you're trying to ensure that your supply chain's healthy, because when they're healthy, your business is healthy. And, I think we have a lot of room. There's a lot of room to grow in corporate businesses around how can I engage, interact, and infuse liquidity to help my suppliers survive, grow, and thrive.
That's almost a great closing remark, but I'm going to ask you, just to give you an opportunity at the end, do you have any final thoughts on adding value in the cash conversion cycle or in the effort to optimize working capital?
I think more than ever, it's very full frontal, right? We're seeing a lot of these supply chain bottlenecks. There's stresses and the pressures, and the supply chain is really getting stretched beyond its infrastructure capability. And I think that's why it's so important for corporates to really be thinking cross-functionally, right? Procurement, AP, finance, treasury, as to ways that they can continue to keep their supply chain healthy. I mean, working capital programs have, the best intentions and are so important to supply chains. But I think that in the B2B world, we are still lagging behind, even some of the consumer digitization, the buy now, pay later, fad. And I think oftentimes I think about, 2008 and what would have happened if we would have had, a network and an infrastructure that would have been able to infuse capital rapidly into our economy, like these working capital programs. Like, how would that have changed the outcome of some of these, economic downturns? And so that's what I think about. That's what I think many of these corporate executives should be thinking about. And there's a lot available to them. So we're excited to partner with some of the world's largest brands to help solve a lot of these challenges. And Craig, thank you so much for having me on. It was an absolute blast. And thank you to your audience for spending some time with me today.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.